Greetings, everybody. Welcome to Liberty Call. Today is, what day is it? Thursday, October 5th, 2023. Hope everybody's having a good day out there in the interwebs. It is a beautiful day here in Colorado. Not so beautiful in the markets. They did try to get back into green territory before the market closed today, but looks like that last little bit of a push for a positive return for today fell short on, looks like all three major U.S. indexes. So that's not awesome, but got some good news as far as jobless claims. Maybe not if you were hoping the Fed was going to lower rates. And I also got an article here about how the Federal Reserve destroyed the housing market and created inflation. So that should be some interesting stuff. All right. If it is your first time watching the Liberty Call, if you could do me a favor, press the like button, the subscribe button, the thumbs up button, all the buttons. Just hit that notification bell so you know when I go live, because you don't want to miss out on all this genius. I mean, come on, seriously. I even combed my beard for this. All right, well, let's go ahead and jump into the numbers for today. Let's see. Dow Jones was, God, I hate when this pops open. Dow Jones was flat, down 0.03%, 9 points, closed at 33,119. S&P 500 was down 0.11%, closed at 4258. NASDAQ down 0.12%. Closed at 13,219. The VIX was down 0.65% today. It's currently at 1846. Canada up 0.54%. Brazil down 0.16%. And Mexico down 2.5%. Woo, that's ugly. Over in Europe, Germany was down 0.2%. The UK was up 0.53%. France flat, up 0.02%. Netherlands up 0.12%, Spain up 0.6%, Italy up 0.2%, Switzerland up 0.25%, and Portugal up 0.67%. Russian exchanges both red today. MOEX down 0.08%, RTSI down 0.88%. And the Asian markets, a lot of them are still closed today, or well, yesterday, last night. The Nikkei in Japan was up 1.69%. Australia was up 0.51%. New Zealand was up 0.95%. Chinese markets are still closed. The Hang Seng was open. It was up 0.23%. And everything else was closed for the day. All right. So, like I said, not fantastic. I mean, I'm sure a lot of folks would like to see positive returns, just month after month after month. But unfortunately, we're going to have to go through this downward cycle that we avoided it back in 2020, with all the money printing and the whole COVID thing. Whether or not that was something real or not, that's remains to be seen. All right. Let's go ahead and jump into today's market recap. S&P 500 struggles for direction ahead of Friday's job report. The S&P 500 experienced uncertainty as investors grappled with concerns about sustained higher interest rates ahead of the crucial Friday jobs report. Everything is always crucial. Have you ever noticed that? No, let me switch this. There we go. All right, get my notes back. All right, where were we? Jobs report, which could influence the Federal Reserve's decision on potential rate hikes. Mixed signals from the labor market, including unexpected fluctuations in jobless claims, a surprising uptick in labor demand, and a slowdown in private job growth have left investors cautious. Yeah, because, you're getting conflicting data. Is the job market crappy? Is it great? Is it somewhere in the middle? Who knows? The forthcoming jobs report is expected to shed further light on the resilient labor market, posing a challenge for the Fed in controlling inflation. Projections suggest the U.S. economy created around 170,000 jobs in the previous month, with a slight increase in wage growth. While Treasury yields saw a retreat, they remain at multi-year highs, with investors wary of potential upside resurgence. A robust jobs report on Friday might signal that the Federal Reserve needs to take further measures to curb growth. Consumer staples face pressure as Clorox plummeted over 5% after cutting its outlook due to the impact of a cyber attack in August. The company anticipates a decline in net sales and a loss for the quarter ending September 30th. The cyber attack disrupted operations, inventory, and supply chains, raising doubts about the company's ability to raise prices to stimulate growth. Rivian Automotive faced a 9% decline following its announcement of a plan to raise $1.5 billion in convertible notes earlier than some expected. Despite expectations of third quarter sales around $1.31 billion, just shy of estimates, the electric car maker faced a market reaction. On the positive side, Lamb Weston Holdings rose by 10% after reporting quarterly results that surpassed Wall Street estimates. Solid demand and price hikes contributed to the favorable performance of the French fry supplier. Instacart declined 3% as Bernstein initiated coverage at Market Perform, expressing concerns about rising competition and its potential impact on the company's digital advertising unit. Instacart, heavily reliant on advertising for revenue, may face challenges in market share and ad revenue growth due to heightened competition in the sector. All right, so that's everything there. Let's go ahead and dive a little deeper into the job stuff. Low weekly jobless claims, shrinking trade deficit boost U.S. economic picture. All right, the U.S. labor market displayed mixed signals as the number of Americans filing new claims for unemployment benefits rose modestly, reaching a seasonally adjusted 207,000 for the week ending September 30th. Although this was a slight increase, it remained within the range observed for much of September. The job market continues to be tight, with employers reluctant to let go of workers due to ongoing challenges in finding labor following the COVID-19 pandemic. The Institute for Supply Management, ISM survey, indicated that businesses still perceive the labor market as highly competitive, with difficulties reported in filling positions. A strike by the United Auto Workers, now in its third week, could impact claims in the coming month, leading to temporary layoffs of non-striking workers by manufacturers like Ford, GM, and Chrysler parent Stellantis. Despite the tight labor market conditions, there are gradual signs of cooling. The government reported a significant increase in job openings in August, with unfilled positions rising the most in 2 years. In a separate report, global outplacement firm Challenger Gray and Christmas noted that U.S. companies announced 47,457 job cuts in September, representing a 37% decline from August. However, layoffs were 58% higher compared to the same period last year. For the third quarter, employers announced 146,305 job cuts, down 22% from the April through June quarter. The data suggests that the labor market strength could prompt the Federal Reserve to keep interest rates higher for an extended period, even though most economists believe the central bank has completed its rate hiking cycle. Well, most economists are morons who don't actually trade or do anything with the market other than just run their lips on TV. All right, where is it? On another front, the trade deficit shrank to its smallest in nearly 3 years in August, with exports of capital goods reaching a record high. This resilience in the face of interest rate increases poses a potential risk, with speculation that the Federal Reserve might consider an additional rate hikes by year end. Economists expect trade to contribute positively to GDP growth in the third quarter after being neutral in the second quarter. The tightening of the trade balance is anticipated to boost GDP, with foreign consumers buying more American goods and the manufacturing industry showing signs of recovery. All right, so it's not all bad. I mean, again, I would not point to the labor market, or at least the jobs numbers and the unemployment numbers, as really a forward-looking device. Those are more lagging indicators. Companies usually have to have bad income and not being able to meet payroll, or it getting very tight before they start slashing and burning, their human capital. All right. One last article here, how the Fed destroyed the housing market and created inflation in pictures. And this was written by Mike Shedlock via mishtalk.com. Get notes up here. All right. In the article, the Federal Reserve's, the article highlights the Federal Reserve's failure to consider rising home prices as inflation and explores the consequences of this oversight. The Case-Shiller National and 10-City home prices are compared to the Consumer Price Index, rent, and owner's equivalent rent. The data reveals a 12-year trend from 1988 to 2000, where home prices, OER, rent, and CPI, and hourly earnings all rose together. However, this changed in 2000, and another trend line shift occurred in 2012, leading to a significant surge in home prices. The article argues that if the 12-year trend had continued, home prices would be 46% too high. The analysis delves into the affordability of homes, considering wage growth, home prices, and mortgage rates. Despite the rise in wages, the article suggests that homes are currently the most expensive ever when factoring in property taxes and insurance. The author attributes this situation to the Federal Reserve's quantitative easing policies, which suppressed interest rates and led to a divide between winners, existing homeowners who refinanced at low rates, and losers, who are the prospective homebuyers. The mortgage rates chart indicates a significant increase, with rates reaching the highest level since 2000. Mortgage applications are nearing 30-year lows, reflecting the impact of rising rates. The winners, those who refinance at low rates, benefiting from increased affordability and extra money in their pockets, stimulating spending. The article also questions the future of rent prices, noting economists' predictions of easing rent inflation. However, the data shows a consistent increase in rent prices for 25 straight months. The author emphasizes the uncertainty surrounding rent inflation, despite theories suggesting that it should ease when more housing units are completed. In conclusion, the article criticizes the Fed for not recognizing rising home prices as inflation, leading to unintended consequences such as a divided housing market and potential long-term inflation challenges. Again, these are all things I pointed out, but just more evidence that the Fed is run by morons. All right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.